We expect one rate hike in 2016, whereas previously we had expected two. Scott Bowman, Capital Economics. The Bank of England left rates on hold today and made no change to its asset purchase programme as widely expected. But Scott, what was your takeaway from the minutes?
Well, we think that the minutes highlighted that the MPC is in no rush to hike rates. We think they showed that markets have gone too far in pushing back their rate expectations recently. The minutes did talk about a weaker near-term outlook for inflation as a result of recent further falls in oil prices. And they also mentioned a weaker short-term activity outlook due to ONS downward revisions to growth and softer business surveys. However, there were actually some hawkish elements in there, especially for the medium-term outlook. They said that the recent falls in sterling should lessen the drag that import prices have on inflation over the forecast period. And also, the fall in oil prices should actually result in a net increase in domestic spending over the medium term.
The BOE held its key rate at a record low of 0.5% for an 82nd consecutive month. Do you think we could see an 8-year anniversary of record low rates come 2017?
We think that rates will, in fact, be increased in 2016. That's a little bit different than what markets are currently expecting. They have the first rate hike due to happen in the second quarter of 2017. We think 2016 should see a fairly rapid increase in inflation as past larger falls in energy prices fall out of the calculations, and this will warrant a rate hike at some point. We do think that sort of the weaker near-term activity and inflation outlook means we now only expect one rate hike in 2016, whereas previously we'd have been expecting two. Our central case still remains for the first hike to occur in the second quarter of this year, but we do acknowledge that the case for a later hike is building a little bit. If, for example, the EU referendum was sort of held around June and July next year, the Bank of England may sort of wait until a little bit later in order to gauge the impact of this referendum before it starts to increase its interest rates.
The minutes triggered a 25 pip correction in the euro-pound. Do you think this will continue over the short term?
So we think that diverging monetary policy outlooks between the UK and the euro area relative to market expectations should mean that there are some further increases in the pound versus the euro. As I mentioned before, we think the Bank of England will hike rates before the market is expecting. In contrast to that, we think that the ECB will further loosen monetary policy probably in the second quarter of this year. We think they'll do that by increasing the monthly pace of bond purchases from its current 80 billion to from its current 60 billion to around about 80 billion. And we could also potentially see another interest rate cut from them. So you've got the UK tightening faster than markets expect, the euro area loosening more, so we think that should put pressure on the pound against the euro.
And finishing up, what should investors keep an eye out for in the near future in relation to that currency pair?
Well, part of the reason why we think the ECB will have to loosen monetary policy further is that we think that growth will slow in 2016 as sort of the boost from falls in oil prices and lower euro earlier sort of start to come through, and that growth will come in below consensus this year. So one thing to look out for is what euro area activity does relative to market expectations. For the UK, the Bank of England has mentioned multiple times that inflation returning to target, which will require interest rates to rise, will rely on stronger domestic cost pressures offsetting external drags. So one thing to keep an eye out for on the UK is wage growth, especially relative to productivity growth, which will give you an indication of how unit labour costs are evolving. And that one thing to look out for is to see whether sort of the recent slowing that we've seen was a temporary phenomenon, and whether wage growth can pick up to a level that will be consistent with the inflation target.
Scott, thank you very much for commenting today. Well, that is all for the moment. Do join us again tomorrow for this week's last trading day. From me, Louise McCauley, it's goodbye.